Welcome to an introduction to a house savings account, or HSA. During this brief presentation, we'll be talking about how HSAs work and answering some common questions, such as what can it be used for, why should I have one, who is eligible, how does it work, and how easy is it to manage. Let's start with the most basic question. What is a HSA? A HSA is a government-regulated savings account that allows you to set aside pre-tax dollars to pay for eligible healthcare expenses. You are eligible to open a HSA account if you are enrolled in a high-deductible health plan. You must not be enrolled in other traditional medical coverage, including Medicare, TRICARE, or healthcare flexible spending account. You cannot be claimed as a dependent on someone else's tax return. The IRS requires a high-deductible health plan to have a minimum deductible for individuals and families, which can change annually. Since the account is owned by you, the money in the account always belongs to you, even if it was contributed by your employer. You can choose to use the money in the account to pay for your current medical expenses, or save it for future medical expenses, including those in retirement. There are many special advantages to opening an HSA. Unlike the healthcare flexible spending account, there is no use it or lose it provision. Any dollars left in your account at the end of the year roll over to the next year, which allows you to determine whether to spend or save your HSA dollars. Another advantage of the HSA is what we call triple tax savings. Here's how it works. Not only does the money deposited into the account reduce your taxable income, but the balance in your account earns interest tax-free, and any withdrawals from the account are also tax-free, as long as the money is used for qualified medical expenses. The HSA is also unique because most banks allow investment options once the balance in your HSA exceeds a certain threshold. And finally, one of the greatest advantages of the HSA is that it's portable. Unlike other medical spending accounts that are owned by your employer, the HSA belongs to you even if you change jobs or retire. As previously mentioned, you can withdraw money from your HSA without paying taxes or a penalty, as long as those dollars are used to pay for qualified medical expenses. Qualified medical expenses include deductibles and coinsurance, dental and vision care expenses, certain over-the-counter supplies, and some insurance premiums. Eligible expenses include expenses incurred by family members, spouse, and children, even if family members are not covered by your insurance. Using your HSA is easy. Let's start by talking about contributions. Both you and your employer can contribute money to your HSA. Remember, employer contributions are not taxable to you as the employee, and once money is deposited into your account, it belongs to you. The best way to contribute to your account is through automatic payroll deductions. Not only is this convenient, but payroll deductions help you make consistent contributions to get the most tax savings. Plus, you have flexibility to change your payroll deduction at any time throughout the year. If you fund your account on a post-tax basis, you'll realize the tax savings when you file your taxes for the year. You have a lot of flexibility when contributing to your HSA. You can put money into your account at any time during the year, and you can even contribute up until the tax filing deadline, which gives you more time to fully fund your account. Let's talk about how much you can contribute to your HSA. Every year, the IRS sets an annual maximum amount that can be contributed. This maximum is based on your health plan contract type, single or family. These maximums include contributions made by you as well as your employer, and combined, you cannot exceed the annual limit, so it is important to monitor your contributions and adjust accordingly. There is an exception for account holders who are age 55 or older that can contribute an additional $1,000 each year. This is called catch-up contributions. There are a few things to keep in mind when using your HSA. Withdrawals from your account are tax-free, as long as the money is used for a qualified medical expense. Expenses must be incurred on or after the date that your HSA is open, so make sure you get your account set up right away. Expenses can be reimbursed only up to the balance in the account, and there is no time limit on when you can request reimbursement for an expense. You can wait as long as you want to submit an expense. Just make sure you keep all receipts and documentation with your tax records. When you file your taxes, you will need to indicate how much money you contributed for that year, as well as how much you spent. You will receive tax forms from your HSA bank to reflect withdrawals made. In the event that you are audited by the IRS, you'll need to provide proof that the money you withdrew was used for qualified medical expenses. You will pay income tax as well as a 20% penalty on HSA dollars used for ineligible purchases if you are under age 65. Please note, if you're over age 65, withdrawals for ineligible expenses are only subject to income tax and not the penalty. Check with your tax advisor if you have any questions. You can check with your employer for annual open enrollment resources that will indicate the current minimum and maximum set by the IRS regarding high deductible health plans and health savings accounts. You can also refer to IRS Publication 502 for a comprehensive list of eligible expenses. Thank you for listening. We hope you enjoy the convenience and control that your health savings account has to offer.